Hi everyone and welcome back to the Arskata channel. This is Payam, and I'm here with another video on fair value gaps. If you haven't already subscribed to the Arskata YouTube channel, make sure to hit that subscribe button. Also, follow us on Instagram and Telegram to stay connected and updated with the latest news. Let's dive in. One of the key concepts we frequently deal with in smart money, which gives us excellent entry points for trading, is the fair value gap, also known as imbalance or inefficiency. You've probably seen a chart of a currency pair and noticed a big momentum candle with a huge body. In such cases, the first thing you should check is whether a fair value gap has formed in that area. Now, let's see how we can identify fair value gaps. A fair value gap is usually marked by a strong momentum candle. To find it, we look at this strong candle and compare it with the candles before and after it. We then mark the shadows of the first and third candles. The space created between these shadows is what we call a fair value gap. In the first example, we look at these three candles and mark the shadows of the first and third candles. As you can see, there's a space here which we call a fair value gap. In the second example, the middle candle is completely covered by the neighboring candles, and there's no gap present. In the third example, if we mark the shadows of the first and third candles, we get this space. However, this fair value gap isn't valid and is incorrect. Why? Because there's an inside bar here. Whenever we have an inside bar, we consider the previous candle as the mother candle. So, as you can see in Figure 4, the correct fair value gap is based on this mother candle. Take a moment to look at this image, and then we'll move to the chart to identify a few fair value gaps for you. So, here we have a fair value gap. Look at this candle, it's a momentum candle. We mark this candle and also mark the shadows of the candles before and after it, defining this area. This space we see here is what we call a fair value gap. Now, in this area, we have another fair value gap. You can see a momentum candle here as well. We mark the shadows of the previous and next candles, so this area becomes a fair value gap. Usually, the price will come back and react to these fair value gaps. As you can see, the price has come back up and filled this fair value gap. Let me give you a few more examples to make it clearer. Look here, we have another gap in this area of the chart. Look here. I'm talking about this part of the chart where we see a fair value gap. Notice that fair value gaps are usually identified by momentum candles. Here, I see a momentum candle. The first thing I do is check if there's a fair value gap. Again, we have a fair value gap here. This chart is for Ethereum on a 4-hour time frame. Let's check another currency. For example, let's open the Bitcoin chart. In this area, we have a fair value gap. And this area here is also a fair value gap. Here's a fair value gap. Look, you identify 3 candles. For the middle candle, you draw 2 horizontal lines from the shadows of the candles before and after it. If a space is created between these lines, that space is the fair value gap. You can see in this area that the price has come back and reacted to this fair value gap. Let's go back to the Ethereum chart. I'll give you an example with an inside bar. For instance, here we have a very large gap. Notice that this candle encompasses the 2 candles that come after it. The first candle is the mother candle, and the next 2 candles are inside bars. So we use the shadows of the mother candle to define the fair value gap. This entire area becomes the fair value gap. If we consider the 3 candles after this, that area becomes the fair value gap. You can see how the price has reacted to this gap. It's clearer this way. If you look at these 3 candles, 1, 2, 3, this forms the fair value gap. If you consider the last 3 candles, this also forms a fair value gap. Again, here we have a fair value gap. Now that we've learned how to identify fair value gaps, let's see how to use them. I'm going to teach you the rules for using fair value gaps. In this section, I want to teach you the rules for using fair value gaps when opening trades. Rule number 1, all fair value gaps are one-time use only. What does that mean? Imagine the price is in an uptrend, and during this movement, 2 fair value gaps are created. Now, suppose the price comes down and starts retracing, reaching the first gap. When the price hits this zone for the second time, we no longer expect this gap to react. Essentially, we've lost confidence in this fair value gap, and we expect the price to move on to the next fair value gap. A used fair value gap is called mitigated, and an unused fair value gap is called unmitigated. To open a trade in an unmitigated fair value gap, place your stop loss below the fair value gap zone. However, I don't recommend trading this way. Instead, stay at the chart, set an alert, and when the price reaches this zone, if you get confirmation on a lower time frame, you can enter a long position. So, rule number 1 is that we only open trades in unmitigated fair value gaps. Rule number 2. In an uptrend, we only open long positions in fair value gaps that are in the discount zone. What does that mean? It means when we're in an uptrend, we identify the main highs and lows. Then, we consider the middle 50%, and the lower part becomes the discount zone. So, we only allow ourselves to open positions in these fair value gaps. Similarly, in a downtrend, we only allow opening short positions in fair value gaps that are in the premium zone. So, we state rule number 2 as, in an uptrend, we only consider fair value gaps in the discount zone, and in a downtrend, we only consider fair value gaps in the premium zone. Rule number 3. The fair value gap located in the extreme zone has higher importance and priority. In an uptrend, the fair value gap in the lowest area is more significant, while in a downtrend, the fair value gap in the highest area holds more priority. Rule number 4. We only trade in fair value gaps that result in a break of structure, BOS, or change of character, CHOC. What does this mean? Imagine we are in an uptrend. A fair value gap forms here, and you see it leads to a BOS. When the price starts retracing and moves down, since this fair value gap caused a BOS, we can look for a long position. Now, imagine another fair value gap forms. But this time, the price comes down and breaks this major low. What happens here? Since we lost the major low, a change of character, CHOC, occurred. Now, when the price comes back up, we can look for a short position. Let's summarize. We said that a fair value gap is usually identified by a momentum candle with a very large body. In areas where the gap is created, the price usually moves towards that gap to activate the orders that were left behind and fill the gap. For trading in gaps, we have a few rules as shown in the image. Rule number 1. The fair value gap must be unused or unmitigated. Rule number 2. In an uptrend, we look for fair value gaps in the discount zone, and in a downtrend, we look for fair value gaps in the premium zone. Rule number 3. A fair value gap located in the extreme zone has a higher priority. Rule number 4. The fair value gap must result in a break of structure, BOS, or change of character, CHOC. Now let's look at some examples. I'll use the 4-hour chart of Dogecoin as an example. When you open the chart, the first thing you should do is identify the market structure. As you can see, the market is in an uptrend. Alright, let's identify the gaps for trading. We have a gap here. A small gap in this area. And a gap here that was used. We don't need it anymore, but I want you to see and learn. Notice that this is the inside bar situation I mentioned earlier. There's another gap in this area. Rule number 1 states that gaps must be unmitigated, so we don't need this used gap. Rule number 2 says that in an uptrend, we look for gaps in the discount zone. So, let's assume the price is going to come down and retrace. This means we shouldn't consider this gap. Rule number 3 tells us that the gap in the extreme zone has the highest priority, which means this gap. In an uptrend, the lowest gap has the highest importance and priority. You can place your order here. If the price comes down and reaches this gap, your trade will be activated. However, I don't recommend doing this. My suggestion is to set an alarm for when the price reaches this area, and then open a position after getting confirmation in a lower time frame, which we will discuss in future sessions. So, I place my order here and set the stop loss either below the fair value gap area or below this previous low. Let's see what happens. You can see that this gap here has been used now. Next time the price comes down to this gap, it will likely pass through it and not respect it. Our order was activated in this area. Now that we've fully learned how to identify and trade with fair value gaps, let's explore the story behind fair value gaps. Suppose a gap or imbalance or inefficiency has formed in a higher time frame like the 4-hour time frame. If we go to a lower time frame, like the 15-minute time frame, we see that the price has moved very sharply with high momentum, and buyers are much stronger than sellers. This means that whatever sell orders were placed, buyers were immediately buying them up without caring about the price. They were buying at any price. So, what happens here? Many traders place limit orders in demand zones, like order blocks on the 15-minute time frame, hoping the price will retrace and activate their orders. However, the buying pressure is so high that the price keeps getting pushed up without any retracement. Other traders, seeing that the price didn't retrace, place their orders at higher prices. This creates an imbalance between buyers and sellers, which we see on the chart as a gap. This area becomes a liquidity pool. As we know, market makers are always looking to grab liquidity, which is why we say that in most cases, the market will retrace to fill those gaps. Thanks for watching. If you enjoyed this video, don't forget to hit that subscribe button and give it a thumbs up. Leave a comment below with your thoughts or any questions you have. Catch you in the next video. Take care and stay tuned.